Hey friends, it's time for another episode of Navigating the Markets with me, Markets and Mayhem, brought to you by TraderAid.com, where we help our members sharpen their trading edge by cutting through the noise. The first chart we have on screen is the S&P 500 E-mini futures contract, which is cutting back towards recent lows, a pretty key area for the market to make up its mind as to what it wants to do with what appears to be a new downtrend, one that has started over the summer and continued to build into October. It's interesting as well because we are in a time of year that is typically positive seasonality for this market, but the market hasn't responded accordingly, at least of yet. There are countervailing forces, of course. We're in this peak buyback blackout period. We have rates that are soaring, increasing concerns that the Fed's steadfast resolve about highest for longest may indeed be true, and there may even be a hike or two ahead to consider, particularly with inflation not anywhere near where the Fed wants it to be, and some signs of it potentially reaccelerating. This is not something that's made this market happy. We can see it in the chart, and on the other side of this, rates were rising, liquidity was falling, and we see more signs that this war against inflation is really nowhere close to over. Energy has soared, particularly diesel. 1 month it was up over 40%. We're seeing services costs continue to ratchet higher, and prices paid and received in manufacturing in many regions as well. It smells a little stagflationary out there. We are also at the end of this positive fiscal impulse that it helped GDP to appear stronger than perhaps the economy really was. And we have some other factors that are coming into play as we enter the government's fiscal year for 2024 that whenever they figure out their budget, it's likely to be a lot larger than last year's, and that's before we consider the interest payment. That's going to have an impact on debt issuance, which will likely be of longer tenor. So we'll talk a little bit more about some of these, but first we're going to focus on a series of major equity market charts, because it's not just the S&P 500 that's breaking down here. On this chart, we're below the 20-day moving average, the Ichimoku cloud. We're heading back towards that point of control at about 4150. RSI has turned lower, well below 50 and continuing to trend lower. And the October trend line from those lows has been decisively invalidated, shall we say, closing below it for 2 days in a row. And while we've seen that before, this selling does appear to be more decisive. There's more conviction, there's higher volume, but more important than that, there's also broader breadth in the selling. So I think it's important that we take a step back and realize that the risks are rising meaningfully, and not just here, but around the world in many different crucial markets. I have been of the mind that I was very cautious to call the move from the lows to the present a new bull market. It's been carried by about 7 to 10 stocks by any measure, with the rest of the S&P 500 largely left behind. The average of the rest of the 493, for example, is only up low single digit percentages year to date, about 2% at this point. Why does that matter? Because in most bull markets, the small caps and the equal weights lead. And in this one, that hasn't been the case. It's been very concentrated. So some of the things we're going to talk about in today's Navigating the Markets are going to break down what I'm seeing, why I take a bigger picture view and then zoom in to a lot of these areas. We're going to obviously start with these charts, but then we're going to work our way into a lot of the relationships, intermarket dynamics, macro, and other components that I view to get to this point that I am right now, where I feel like we have much greater risk to the downside. Obviously, in the short term, anything can happen, but I do believe that the easy times for upward momentum in this concentrated rally are behind us, and volatility is going to rise. Downside potential has been increased. That left tail has fattened quite a bit. And those risks have yet to be fully appreciated by equities that are still sort of in la-la land, particularly when we think about what's happening in the bond market. But first, let's look at the NASDAQ, because the NASDAQ is a long duration risk asset. A lot of the stocks in there actually have a reasonably high correlation with the price of the 10-year treasury and its performance. So we like to look at them similarly because they're both long duration assets. And yet there's been a breakdown with that positive correlation this year, with NASDAQ stocks surging, led by those mega cap Magnificent Seven, and the rest of the market not really showing that same momentum. So a lot of rot underneath the surface in the NASDAQ, which has been the momentum leader this year. So we're going to focus a little bit on that. First, we're breaking out of this pattern to the downside, which to me is disconcerting because it tells me sellers are gaining momentum. Now we're below the yearly point of control, this trend line I've drawn, as well as the 20-day moving average, with RSI turning lower. We're also below the cloud, having tested breaking above it a couple times. And all this tells me sellers are thoroughly in control of the tech-laden index here, that we're at a very crucial area where at least we could get a bounce before we go into an area of the volume profile where there's been a lot less buying and selling activity. In that area, should we cross below current levels, it's likely that we see volatility pick up rather significantly, similar to what we see in the S&P. Why might that matter? Because the trading journey this year has been relatively uneventful. Sans some of the stuff that happened in the banking system, and if you look at this chart, you can barely even tell there was a blip there. This has, until later summer, been a relatively uneventful rally, which is unusual. In fact, it was so unusual that it was one of the longest periods of time where there wasn't a 2% or greater drawdown in the NASDAQ or the S&P. Hundreds of, I believe it was like 150 days, at least 120 days before we saw some of the not so pleasant downside activity really start to pick up. What's important about this, though, is we're seeing a breakdown. And we're not just seeing it in the price of the index, which is so weighted towards these mega caps that it's really hard to get a good firm beat on what's happening underneath the surface. No, we're seeing a breakdown in a lot of the components as well. And this time, as we get into earnings season, I think expectations, which have risen, people are largely looking at quarter two earnings as potentially being the trough and expecting to see a resumption of growth. We'll see if that happens. We've got a lot of important earnings reports coming up next week with Alphabet, Microsoft, Amazon, Meta, and other NASDAQ heavyweights. And this is going to help to discern for investors and for longer term traders just how much the expectations that have been built into this earnings season, which are largely more positive, will be met by these companies. Now, this year has been more about beating really low expectations. And companies have been able to do that, and investors and traders have been willing to look past that. Earnings growth has not really been happening. I mean, Apple added $1 trillion of market cap, and if you net out buybacks, their earnings have slowed in that same period of time, which is amazing. The biggest company in the world grew by 50% during a time where both its revenue and earnings adjusted for buybacks were actually falling. That's something that should concern people because that's not normal. And the average PE of these mega caps has gotten absurd. I believe it's about 45, 47. We'll go into that shortly, but it's high enough without the growth to warrant it that a significant discount is warranted, particularly given that the equity risk premium in NASDAQ and S&P stocks is inverted versus the 6-month Treasury bill, meaning these things are very expensive. The most expensive they've been by that measure in about 23 years. Now let's have a look at our friend, the Russell 2000. We all know that Horst hates this index and hopes that one day it eventually reaches its fair value of 0. But we're seeing some signs of a greater breakdown here. Really, this is a new year low for the Russell. It's been in this trading range. There was a lot of false hope of a breakout over the summer. We just narrowly got above some of the highs that we saw earlier in the year, and then it's been downhill from there. The index is below the 20-day, the cloud, the point of control, and this key support level. The only thing it has going in its favor is RSI is looking kind of washed out. But to me, that only gives it the opportunity to maybe back test that point of control, or maybe even lower just the level of support it broke down from, and continue its journey down. Now, as I mentioned earlier, in most bull markets, small caps and equal weight lead. This is not what a bull market should look like. You should not have this anemic of risk appetite in the area of the market where people would expect the greatest potential for returns. Now, Put your feelings of the Russell aside, the fact that the index has nearly 40% of its components that don't make any money, that there's a lot of regional banks in here. At the end of the day, if there were real bullish animal spirits, the rally should be broader and there should be much, much more energy in these small caps. Now let's take a look at the 10-year note. This is a terrible looking chart. And you can zoom out and go all the way back to 2020. This thing topped out in mid-2020, and it's been in a downtrend really since early 2021. Why is this important? Because I know a lot of people are very eager to get long U.S. sovereign duration. And I've said that as long as the long end is yielding less than the short end, there's no reason. And we're coming out of inversion or close to it with the 2s and 10s. That's a good initial start. But coming out of inversion to me, I want to see what I want to see when I say that is much more of a delta between the long end and the short end. For example, if you're lending government, the government money for a period of 10 or 20 or 30 years, the rate that you're paid should be so much higher than what you're earning on the short end. So, a 6-week or 6-month bill should be comparatively much lower in yield than the long end. I mean, I'm talking about by 100, 200, 300 basis points, because it makes sense to assign a risk to a distant point in the future where there's greater uncertainty about what the government's finances will be, what the purchasing power of the dollar may be, and also what the risks, if you're doing this for capital appreciation, what that might be in just the intermediate to short term for people that are trading these things rather than buying them for the coupon and holding to maturity. Either way, it does not seem like a very advantageous period of time to be getting long U.S. sovereign duration where there's plenty of opportunities in bills. Bills to me still seem like the most attractive part of the Treasury yield curve to be allocating into, because when they roll off, when they mature, there's another opportunity to reassess and see if things look better. If the 30 years yielding 6% and the 2 years yielding 4.5%, there's that 1.5% difference. That's where the 1.5 came from. That's where I would be more interested, because there's that delta that tells me there's a premium for that longer duration debt. We don't see that. And until we do, I'm not very interested in this stuff. Trading it, if we're looking at it from that perspective as a swing trade for that sort of counter trend pop, I would just say for me, with how brutal the selling has been, I would rather wait to see a reversal to get involved with a momentum change than to hope for maybe just a little pop that's likely to be sold aggressively into. The character in this market has changed so much. I cannot emphasize that enough. U.S. sovereign duration used to be the place that people would run to when there is a geopolitical crisis or any other kind of fear-driving event, like a sell-off in the markets. And there's been a sell-off in the global markets. There's been geopolitical risks that are rising as we've had the tragic events unfold in the Middle East. And yet, U.S. sovereign duration is not enjoying much of a bid at all. It's selling down to new lows we haven't seen in price since 06, 07, and similarly in yields. This is a difficult situation because the yield of the 10-year, for example, is a benchmark that over $100 trillion of global debt, much of which is denominated in dollars, keys off of. So you have rates rising, you have the dollar appreciating, making that debt harder to satisfy for folks that are paying for it in any currency, but particularly anything that isn't the dollar. So there is some sense of a potential global margin call in the way that rates have risen. The median 10-year global rate has had its fastest rise ever, and that is likely to put pressure on the cost of refinancing, maintaining revolving debt, and also liquidity is becoming more constrained. So this is all happening during a time where there's record inflows into bonds from U.S. investors, retail, and institutional. The Fed is no longer a bidder at the auction. China has stepped back. Saudis have stepped back. Japan has stepped back. So the foreign bidders that were very meaningful participants are no longer quite participating the way they were, if at all. And that's not to say that we don't look at the other side of the coin too, where supply is expanding of treasuries and a lot more longer dated tenors will be sold, which tells us what? It tells us that it's likely that this appreciation in yield and this fall in the price of notes and bonds is not over, particularly from the 10s and 20s and 30s. So, from my own humble opinion, it makes sense to be careful here. I don't think we've seen a bottom in U.S. sovereign duration. We might see some relief. That's about the best I think we can hope for in the short term. But in the longer term, I don't think that we've seen the lows in these prices or the highs in yields on the 10s and 20s and 30s. And I don't think that it's a wise decision for investors that are looking for this as a capital appreciation vehicle to start longing here. You might be able to, get some capital appreciation in the short term, but odds are against it in the longer term. It's much more likely that we continue moving lower here with all the factors at play in terms of price, and that should offer better opportunities for a capital appreciation driven trade when that reversal happens, likely at a significantly lower price. But whenever it does happen, that's when the odds are in your favor. Why not wait for the really big players in the market to tell us it's time to get long? Yes, I know it's been one of the worst bond bear markets in history, but cheap, or what seems to be cheap, can get much cheaper. And a lot of folks don't think this stuff is cheap quite yet. Next, we're looking at crude oil. Crude oil continues to enjoy a strong uptrend. This was a trend line that I discussed on the TraderAid Discord, and we actually caught the exact bottom on this trend line not once but twice, giving us opportunities in energy stocks and in crude futures for those that are so inclined to trade to take advantage of this resurgence. Obviously, it happened because of terrible things that are going on in the world. So I understand people not wanting to trade this, and I have no judgment about that whatsoever. But it's our job to discover where there's opportunities in this market. I've been very focused on commodities because there have been excellent trading opportunities. Some of these things trade so much more technically and momentum driven than what we've seen in equities that there's been arguably better trading opportunities from a risk reward perspective. And this has been one of them. I've been adamant about getting long crude since summer when positioning was very lopsided in the high 60s where everyone was short. And now we're starting to see everyone get really long this stuff. So I'm much less bullish, as we talked about in this week's midweek update, than I was. But I've also given the strong caveat that as long as there is event volatility catalyst to push this higher, it's likely to enjoy further upside. So my position on crude right now is caution is warranted for crowded longs in the futures, but energy companies, some of them still look very attractive. There's a number of names we've talked about, like Chevron and Southwestern, that could be interesting in light of what's happening. But at the end of the day, for the futures itself, I don't want to be very long here because it's a very, very crowded trade that requires more chaos for more upside. And that's not something I really want to bet on. The next chart we have on screen is gold, which has really grabbed everyone's attention. The yellow metal has been surging, breaking over $2,000 on Friday to about, I think, 2008 and change, which was close to a high that we had seen over the summer. And it's a key area of potential technical resistance. It's also where the volume profile thins out, and we did see some selling come in, and we closed below 2,000. RSI is pretty stretched. It doesn't mean gold can't move higher, but it does suggest there's some potential buyer exhaustion beginning to play out here. I don't want to be long gold here. For similar reasons as crude, I think this trade is a little long in the tooth, and it's a great time to look at scaling out of these positions, whether they're in miners or the yellow metal itself. For me, I would want to be flattening out, and if there's any change in what's happening overseas, I would look for positions to fade this move. But at the end of the day, in the here and now with what's going on, with this metal moving almost $200 to the upside in less than a month, I don't want to have a ton of exposure here. Now, let's look at the US dollar index. This is another one that's pretty important for gold. My view on gold could change if this breaks down. But for now, it's holding at the 20 and this key area of support that I've drawn, and we're well above the point of control and the Ichimoku cloud. Now, one concern is momentum is fading. You can see it with RSI trending lower. So this is not one that I want to be long here. I have no interest in US dollar longs at the current time. I think we're consolidating. I think this looks kind of like the price action we saw during September. So I'm kind of seeing if we have that same sort of consolidate, and then breakout type of a move. If we do, I'll be looking at that as another sign that some of these dollar pairs will be interesting, right? Like fading the euro versus the dollar, fading the yen versus the dollar, etc. But in the here and now, I don't want any exposure to those pairs or to the dollar, because I think that we've had a fantastic move. It is one that we've been talking about for quite some time. I said over the summer, I thought the dollar was going to bottom. I thought it was unpopular opinion because people were saying it was going to go to zero, and the U.S. Entire influence over the world monetary and economic system was going to end abruptly and overnight. Obviously, that hasn't happened. And as usual, when everyone believes one thing is true, the opposite happens. And so the dollar rallied. And now I think we're closer to the end of that move in the near term. I don't think we're near the end of that move in the intermediate or long term. Consolidation is healthy. This is still a bull in the dollar. This consolidation is exactly what you want to see for it to continue to kind of coil up like a spring so it can move further higher. But if it is going to move to the upside, it's going to rely on one key thing. Can you guess what that is? If you guessed rates, that's correct, particularly on the long end. The long end moving higher is likely to drag the dollar with it. There's a pretty strong correlation between the two. Now let's look at the Euro Stoxx 50. What do you notice? It's breaking down. So we talked about the S&P, the NASDAQ, and the Russell. None of them look great. And by the way, if you want to pop a Dow chart, it looks pretty bad too. We're going over to Europe here because we talked enough about some of these U.S. equity indices and assets that I think it's time to expand our horizons here. This is the Euro Stoxx 50. It's kind of like their version of the Dow, and it's breaking down. It's actually re-exploring some of the price action that we had seen during that springtime financial crisis with Credit Suisse and with the U.S. regional banks. Now, I think this chart looks pretty terrible. We are going into big European bank earnings next week, so I don't want to be just shorting blindly here, but I do want to look for some potential of back testing and moving lower or continuation, depending on what plays out. We also have that ECB rate decision. So just keep all that in mind. This isn't a time to just wildly short with both hands, but it is a time to watch what's playing out. This is another bit of feedback from the global markets that there is a breakdown happening. It's not just the US. It's not just a handful of stocks that are weakening. It is a broader global de-risking and deleveraging that is happening. And this is not something that you just want to stand in the way of and say, oh, well, stocks only go up. In the very, very big picture over a course of 100 plus years, that's true. But in the smaller time frames, stocks actually have a lot more risk to the downside. And even over the intermediate time frame, I think it's important to be cautious here. What we're seeing is the market telling us in no uncertain terms that a lot of investors want to cut their exposure to risk here. Let's look at the Nikkei. It is not quite as terrible as the S&P or the Euro Stoxx 50, but it looks bad. It is re-entering a downtrend channel that started over the summer. It's broken below the 20, the cloud, and this key area of support, and it does seem like it has room to move lower with RSI melting below 50 with continuation. Now, I'm not saying we're getting back to that point of control, but it wouldn't be terribly surprising if we did. This rally in Japanese stocks, which are arguably cheap and perhaps value traps, is likely to be challenged by the yield curve in Japan expanding on the long end, but also because global liquidity is diminishing. Global rates are rising, providing many attractive allocations outside of risk assets. And also, the global credit cycle is ending. Japan's central bank is one of the last in the world that's still in somewhat expansionary monetary policy. They're very slowly turning about that ship. They won't be able to go all the way. They won't. They'll get to the point where there starts to be some increasing tension in their markets, enough to warrant them potentially standing back from tightening again. I don't think that Japan's central bank will be able to do a whole lot, but I could see them getting the JGB 10 years well above 1% before things unwind. And I think that what's happened in the Nikkei is just as likely to retrace a lot of these gains, because a lot of the problems that are being experienced in Japan are only intensifying. Inflation, the diminishing purchasing power of the yen, how one plays into the other because the Japanese economy is reliant on a lot of imports. The yen is losing purchasing power. That's making those imports more expensive because many of them are being bought in dollars. Those are all concerns that we need to pay attention to, as they may have impacts on the appetite for risk in Japan. Demographically speaking, the country is also in serious trouble as it has a negative population growth rate, and older savers are beginning to sort of cash out more, and younger folks are not really saving the same because A, wage growth has been pretty terrible, and B, there's a lot of economic pessimism over there, unfortunately. So I think it's a time to be a little more cautious. I know that some people have made some great money in Japan. We were among them. We had the long Japan, short China trade. I didn't even see anyone talking about it, and that trade killed it this year. It was up about 20% before we looked for the exits in a very short period of time. But now I'm on the other side of that. Now I'm looking at Japan and saying, gee, it doesn't look so good over there. Now, it doesn't look as bad as China, my goodness. But it doesn't look so good. Speaking of China, here is the Shanghai Stock Exchange Composite Index melting down to new lows for the year. Remember that whole great reopening idea, trade, whatever you want to call it, that so many folks were excited about at the end of last year? I couldn't get excited about it because I needed to see stimulus. It's a year later, I still need to see stimulus. Apparently, investors are thinking the same thing because they don't like what's going on in China. The leadership there is really just one man who seems to be ever determined to destroy the confidence of investors and what limited elements of a free market they once had. And remember, China is a communist country, so there isn't any real free market, but they had zones in the country where there was less bureaucratic interference. Well, that's sort of over with all this ham-fisted cracking down. Combine that with a lack of stimulus, inability to reinvigorate the Chinese consumer, exports falling, and the real estate industry in dismay with defaults growing by the day, the situation in China does not look good. In fact, it looks like this may be a downside catalyst for the rest of the global economy because China is such an important player. Now, here's a look at the total stock market ETF from Vanguard, and it has repeatedly tested this point of control, just short of 1 year period, right? And it's been rejected there repeatedly. There's a lot of trap supply up there. This too is in a downtrend, lower highs, lower lows. So now we're at this very key level. If we break below it decisively, and I'm going to say getting below it decisively, looks like a close of about 206.50 or so. I'm going to say that is going to be another sign that global equities are in trouble. This is not what you want to see if you're constructive on risk assets. You could say, oh, it's just a healthy pullback. But what we're seeing in global markets suggests there's much more than just a healthy pullback going on. Now let's take a slightly different look at things. This is from Bank of America, and this is their bull and bear indicator saying it's time to buy because participants are too bearish. And perhaps it's true. Maybe it is time to buy. Equity market breadth has been very bearish. Bond flows have been very bearish, but hedge fund positioning remains bullish. And in fact, they've been adding to their net longs here. I look at this indicator with just a slight degree of skepticism. I don't think that it's time to buy for anything else in a short-term bounce. We'll talk about why, but essentially 4,200 on the S&P 500 cash index could be a pretty key area of psychological support. Just below that 4,150, based on where the volume profile has built up a lot of activity over time. But if we cut below there, I think that that's going to put those hopes behind us. And if we do break above, if we do get sort of a bounce and a counter trend pop, I would be very surprised if we break out of this downtrend. The only real catalyst that I think would help is a earnings season that surpasses all these increasing expectations and a Fed that makes it pretty clear in their November meeting, which is coming up in just about 2 weeks, that they are done. Like not hiking again and going to NQT before people thought, which neither of those things to me seem incredibly likely. but anything can happen in this market. Let's look at managed money, which they, by the way, last week, this survey is taken on Wednesday and released to the market on Thursday, increased their long positioning a lot, which is the first time we've really seen them do that during a dip. Typically, they're buying the rip. I'm not sure how well this will go. They're not in any way at an extreme in long positioning, but they're long enough that there's some decent selling to do if markets continue to move lower. Now, this is a really telling chart. The Big Seven as a total percentage of U.S. single stock net exposure. This is a very crowded trade for a lot of reasons. It's an area of the market that I'm exceedingly uncomfortable with because the valuations are in nosebleed territory. They are an enormous weighting in the indices, and they are a concentrated allocation. So if anything happens to even one or two of these stocks, you could see a pretty big change in the character of this market for the worse or the better if they do something amazing. Now, the S&P 500 current earnings yield has dipped below the 6-month Treasury bill yield. This inversion of equity risk premium is worrisome. Arguably, there's no reason to be in stocks here. And unless and until earnings really do improve, this tells me that being in Treasury bills is the best place in the market to be. It's a truly risk-free return. And for those that don't want to keep rotating their bills, there's always the money market as well. But at the end of the day, I don't see any reason to be long S&P with a market that continues to get more expensive as the rise in rates is outpacing the fall in stocks. And that's what this chart is in part showing us. Now, we can obviously get to a period where this is no longer true. I mean, look at what we were seeing in 2009. Look at the current earnings yield in the S&P versus the 6-month Treasury bill yield. That was obviously a generational buying opportunity. That was such a huge equity risk premium. It's unlike any other period of time in this chart. The only thing that's even remotely close to it is that COVID crash where they cut rates and equity risk premium surged because obviously equities had a big haircut during that crash. We are in the opposite scenario now. Equities are arguably very expensive, and it's not a good time to be getting super duper bulled up, in my humble opinion. Now, obviously, I know there's detractors. I know there's other folks that look at this differently, and I have all the respect in the world for them, and I might disagree with their views, but that's what a market is made of, is people of different views expressing those positions in one way or another. My view is that risk is extremely high. And the total PE ratio for the S&P 7 has this year gone from 29 to close to 45, that level I was talking about earlier. This is nuts. These stocks are not growing at 45%. They're not growing even at 29%. Some of them are not growing at all. NVIDIA is the biggest growth engine in these stocks, and it's priced irrationally high in terms of its valuation. So what does this tell us? It tells us objectively that this part of the market is concentrated, that investors have a lot of exposure to it, and it's objectively very expensive. And with equity risk premiums as inverted as they are, it suggests that this is not sustainable. There's better opportunities in fixed income for people that want to hide and wait for more reasonable equity valuations. Now, if we look at the S&P 493, they look a little more attractive. Their PE is just below 19, but given interest rates where they are and earnings as slow as they have been, and really for many quarters and in earnings recession, it still does not appear attractive. But if I was to put a trade on based on this chart and some of the others, I'd say long equal weight, short market cap weight. I think it's a trade to consider over the next year. As we look at the Magnificent Seven as a component of the S&P 500, they make up 30% of S&P 500 market capitalization, which means that for every dollar you put in the S&P, 30 cents go to just 7 stocks, and the other 493 compete for that other 70 cents. Is that not wild? I think it's pretty crazy. This is the highest concentration that the so-called Magnificent Seven have ever had in the S&P 500. So when we look at the ratio of performance between the market cap weighted and equal cap weighted S&P, you can see where I kind of have that trading idea coming from, right? This is an extreme. And this is a bull market? Is this really what they're supposed to look like, where there is so much concentration in so few names? Because when we go back in time, that's not what bull markets typically look like. They typically look like the opposite, where there's expanding breadth, where there's greater participation from small caps and equal weight. And what this looks like to me is a lot of risk in very few stocks, where if anything materially goes wrong with them or the broader market starts to roll over, they're going to lead us on the way down. And that would be pretty meaningful because they make up such a high weighting of the S&P and the NASDAQ. So as a potential mean reversion or ratio reversion trade, I would be looking at fading the market cap weighted S&P and going long the equal weighted S&P. Now, I'm not looking at doing it right now because I want to see the ratio change and favor relative strength in the equal weights. What I want to see is institutions buying more of those and getting out of the hyper weighted, super duper mega cap stocks. I really need to see that relative strength shift. So it means you miss out on a portion of the move, but it also means that if the move happens, it's much more likely to work in your favor. And what we would be looking at in that trade is benefiting from institutions getting out of these really concentrated names and getting into more equal weighted names and benefiting from both sides of those flows. So this is a trade that we'll keep an eye on at TraderAid, and once it sets up and looks like it's going to be in our favor, we'll be talking about putting it on and how to manage it. Returns of the S&P 500 equal weight index and small caps 1 year after a bear market low, which is where we are here. We are about 1 year later after our bear market low, and guess what? The S&P 500 market cap weight is leading. Equal weight and small caps are barely anywhere to be found. This is not what the start of a bull market usually looks like. This is why, for a while, I've been saying something isn't quite right. The data we're seeing here confirms it. Because if you look at the markets that started from the bear lows of 1982, 87, 90, 2002, and 2009, those bulls that were born were led by equal weight and small caps. This is not anything like that. Not only are the gains more subdued because it happened from higher prices and valuations, but they're also much more concentrated. I dare say this has not been a bull market at all. It doesn't look like any of the prior bull markets we've seen, and it certainly, when we dig into the details, doesn't seem to have the same kind of staying power or upside potential. And where's the participation? Here's the NASDAQ, number of stocks above the 200-day moving average. If you look at the post-COVID crash bull, that participation was very high. And you can zoom out this same chart. It's $NAA200R on stockcharts.com. And you can see during prior bulls, that participation was also higher. This time it's not. This time the upside participation, the number of stocks above their respective 200-day moving averages, never really got much above 50% in the 2023 so-called bull market. Maybe it isn't one. New lows are also increasing week over week in the NASDAQ new highs versus new lows measurement here. This chart is now showing 520 new lows in excess of new highs last week, the worst that we've seen since the Silicon Valley Bank meltdown. This matters. This is what I was talking about, the rot underneath the surface that is causing more problems in this market. This is, in my mind, another sign that there are deeper problems that we're not necessarily seeing at the top line mega cap weighted index level, right? Because when you look at the NASDAQ, the mega caps are about 40%. You look at the S&P, they're about 30%. You're not going to see it in the index. But if you look at other metrics, you can see very clearly that underneath the surface, this is not a healthy, happy market. It's not as bad as 2022, at least not yet. But this is not what a bull market looks like. If you go back on this chart to 2021, and you can go back further to 2020, even through prior cycles completely, this type of activity is much more, these breaking into new lows, this rot underneath the surface, narrow breadth, extended valuations. This often suggests there's more downside ahead. And the share of American households with stock holdings is at an all-time high of 58%. And the component of net worth of households allocated into equities is also near all-time highs. This is a market where retail is very, very, very long. And I dare say it may not end so differently than some of the other situations where retail has been very, very, very long equities. That is to say, the risk of the downside and pushing a lot of folks out because of the scars that are left for many years to come is very elevated right now. When everyone's in the boat and they're all on one side, it gets a little lopsided, and that's kind of how this market is. And you might say, but look at the money markets. There's so much money left to come in. Maybe there is, maybe there isn't. I would argue a lot more of that money wants to go into fixed income than U.S. equities unless prices and valuations come down a lot. Tech flows were negative last week, and really over the last 4 weeks, we're seeing a bleed out of what was once the leadership this year. This is important to me because seeing these outflows is telling me there is a change of character and appetite. Remember, this market was led by AI and this mania in a lot of stocks, some of which were AI peripheral, some of which had nothing to do with AI at all, including the symbol with that same namesake, C3AI. I think that this shows us that the character, the risk appetite in these longer duration assets is changing. Now, these are overall tech flows. The mega caps have not seen this type of distribution of yet, but underneath the surface, it's happening. And it's a big deal because I know a lot of people got hurt in mid to late 2021 and then throughout 2022 and pinned their hopes that this was going to be the new bull market and it was going to pull all those holdings that were deeply in negative territory back into positive and it was going to be good times again. I want you to zoom out and think about this for a second. The amount of money that came into the market in response to the COVID crash was unlike anything we've ever seen in human history. It created the largest extension of an already existing multi-asset bubble. A torrent of money pushed up prices and valuations. It pushed up stocks, real estate, bonds, crypto, you name it. That same flow of money is heading towards the exits as central banks take out the plug for the drain and drain global liquidity with quantitative tightening and rising rates. This is not what bull markets are made from. This is not the time to get all sorts of aggressive risk on, buying the dip and thinking that it's great times ahead with more multiple expansion to come. The Magnificent Seven are trading at a PE of 45. Underneath the surface, a lot of these COVID era, bubbly tech stocks and other types of growth stocks, they have never gotten back to their highs, most of them. Some are actually decent companies and have been able to rebound. But the vast majority, I mean like 90+%, are still languishing. It's not a coincidence. This is a tough environment. And it's been a market in 2023 where both bulls and bears could win depending on where you were. There's plenty of stocks going down as the broader market went up. Just like there are good places to be long. Both bears and bulls were right this year if they played things smart. Plenty of pair trades, plenty of trades outside of equities altogether. Shorting bonds, for example, which we've been all over. Why am I talking about all of this? Because zooming back in, too many people have unrealistic expectations of future returns after some of the easiest monetary policy and fiscal stimulus that we've ever seen. And the times that are coming are likely to look a lot different than the times that we've experienced. I suggest zooming out even further in your picture of both global markets and the subdued returns that just about every non-US market has had, with the exception of India and a few others, but also looking at just how much of this is unnatural versus other periods of time in history. I don't think that it's deeply appreciated just how much downside risk there could be. The idea that the S&P could close below 3,000 before all is said and done is very realistic. Now, when we look at trading flows for U.S. equities, we can see that they are grossing back up. What does that mean? They're adding to leverage in their positioning. There's a lot of shorting going on. You can see that. That's the majority of the flows, but they're also adding to longs. So what does this really mean? It means that we have increased potential for volatility because they're getting back to really high levels of gross leverage, between about 250, 260%, depending on whether we look at JP Morgan or Goldman Sachs prime book data. On screen is prime book data from Goldman Sachs. And the long short ratio of hedge funds, it's not really, really long like it was over summer, but it sure is a lot longer than people would think. This shows that grossing up and that the net exposure is actually on the rise. Again, if we see downside, this is another segment that could be motivated sellers on the one side of their book and potentially covering some of the more crowded shorts on the other. And what do those flows look like for these same folks in the world of hedge funds? Well, Goldman Sachs shows us that energy, utilities, industrials, and information technology, along with healthcare, have been heavily sold. Now, to me, that means that if we do see some real serious selling in the broader market, that some of these pockets where there's concentrated short positioning may actually rise. I know some folks get a little confused or bewildered, like when you have a day where the NASDAQ's down 2% and the Russell's up 1%, or you see these other really crappy stocks rallying as the rest of the market's bleeding out. Often is the case that's degrossing. That's when hedge funds are flattening both sides of their book, and it's a big enough effect that it actually impacts the broader market. So when they're super short, they're covering, they're essentially buying, pushing that part of the market up. And where they're very concentrated long, in this case, NASDAQ stocks, they will be potentially pulling that market component down even further. That's that sort of deleveraging, that degrossing that can happen in a little bit of a disorderly fashion if price action catches them off guard. And they're running, 250, 260% margin. That means they're super duper long exposure, but it also means that if their long and short exposure doesn't match properly, that they have to unwind both sides of the book. And, often hedge funds aren't actually properly hedged, so those unwindings happen episodically during times of heightened volatility. But they are quite long. Let's not forget, a lot of folks think hedge funds are just always short the market and, they have all this crazy short positioning on. Anytime you see a chart that suggests that, it's missing the other side of the book. Now, we're in the absolute epicenter of earnings season with the biggest of the big reporting in the weeks ahead. And this is important for us to note as traders and investors because volatility has been about 4.1 times higher than what the average has been for earnings reactions in single stocks over the past 25 years. Translation, another volatility catalyst, particularly as some of the biggest stocks could have much higher levels of volatility than one might expect in either direction. Keep your minds open. And volatility suggests the S&P 500 has further to fall. The VIX has really surged recently on this chart. It is inverted, so down is up is down in the VIX index. We're matching that against the S&P in blue, and we can see the VIX has a pretty decent inverted correlation with the S&P, and it does suggest that the S&P could have farther to fall. Doesn't mean it has to, but it's something to keep in the back of our mind. We also see commodities are surging again. The relative strength of the commodity index versus the S&P 500 is telling us that that relative strength is strong enough that it's worth a look at the broader commodity complex, particularly agriculture, energy, and some of these metals. I think that there will be opportunities. And we're talking about from a swing trade basis. We're talking about multi-month trades here, not intraday, not one day to the next, but longer term trades. So as we go through the next 2 weeks, guess what we have a lot of? I know it's everyone's favorite. We have lots of central bank decisions. Next week, we have the Bank of Canada and the ECB. The week ahead, we have the Bank of England, the Fed, and the Bank of Japan. So lots of fun for everyone. Really, I know you're not really believing I'm serious here. It's not going to be fun at all. But at least we'll be able to get this behind us. And the one really brilliant part about all this is as we approach these meetings, the Fed blackout period starts and there'll be less of their speakers. So we can rejoice in the relative silence ahead of them telling us all over again how they feel about everything. And central banks have been pretty aggressive outside the Bank of Japan, which is just a flat line. The rest of the global central banks that we're tracking here, the Federal Reserve, Bank of England, Bank of Canada, and European Central Bank, have been aggressively hiking. It's been one of the most aggressive hiking cycles that we've seen. And yet the Fed still has a lot of work to do on its balance sheet. It has really just under about $8 trillion of exposure to U.S. Treasuries, meaning this QT program, as Mester said last week, likely has more years ahead. So even when the Fed decides to stop hiking or even start cutting, they may still run off their balance sheet, which is another form of tightening. Meanwhile, the Bank of Japan's 10-year government bond yield has risen to cycle highs, and because of hedging costs, that's actually competing with local demand for U.S. Treasuries. You wouldn't think it would matter with a 10-year Treasury yield approaching 5%, but when you account for all those hedging costs, this actually appears more attractive to a lot of Japanese institutions. It also has the effect of further pushing up global yields. And you wouldn't know it because, as I discussed earlier, there's so many inflows happening in Treasuries, record levels. We've seen 36 straight weeks of Treasury inflows, the longest uninterrupted series of inflows since 2010. This is part of a broader bear market. So, you look at the flows and you're like, what's happening here? Well, the cessation of the Fed bid, the Japanese, Chinese, Saudi, and other buyers stepping back where they were very influential at auctions, and just seeing, U.S. retail and U.S. institutions buying with both fists, it's not enough to offset growing supply and net diminishing demand. Imagine what it would look like if they weren't buying. Woo, that would be bad. So, let's look at what happened last week. It was a mixed week. Netflix was up 12.73%. AT&T was up 7.10%, which I think in some circles means that the world is going to end as the Death Star is recharging. Inside joke if you don't get it. And Tesla was down 15.58%, followed by Nvidia down 8.96%. Was not a great week for tech. There were some pockets of strength like we just talked about with Netflix, but overall, the defensive parts of the market did better. McDonald's caught a bid, Coca-Cola, Procter & Gamble, Clorox, and some of these others comparatively were stronger than the rest of the market, along with pockets of green in energy. Other than that, it was really a week of distribution and following along a theme that we've seen for, well, really since August. Now, I don't think we're out of the woods yet. I do think we can have these episodic counter-trend bounces that will bring a lot of the dip buyers back in and get the animal spirits reinvigorated. But I think the path of least resistance over the intermediate term is lower in this market. I do believe that the sort of easy days are over, the party has ended, and that the hangover will be rather unforgiving, particularly for the folks that think they can just trade, buying every dip and just looking for more upside. I think that is something that is in the rearview mirror in terms of where we are in this cycle. And now we're looking at the opposite. And you might say, oh, but Mayhem, you're such a bear. You sound so doomy and gloomy about everything. Look, I was the only person I knew in January of 2022 on the day, pretty much called the top in the market. It wasn't my goal. But what I wanted to warn people about was there was huge downside risk in growth stocks and crypto. Those two areas fell 70% from there. Neither of them have recovered either. So you can say I'm bearish, you can say I'm doom and gloom, but I was also super bullish from 2020 crash on because I saw that monetary policy coming in and stimulating the markets, and it was a torrent of liquidity, and that had me very excited, and I had some of the best years of my life trading and investing because the returns were unnaturally high. Those are not going to be returns you can expect again in the future. That's not something that's going to happen just because, there's not that kind of likelihood that the Federal Reserve and other central banks are just going to flood the world with liquidity when the reaction was giant, intractable inflation. They learned that MMT doesn't work. They learned that QT is not the salve for all that ails us. And unfortunately, I think the impulse to engage in that level of monetary and, quite frankly, fiscal largesse is behind us for some time to come, with inflation becoming more embedded and those risks on the rise in the next 5 or 10 years as supply is inelastic and demand will firm up in the next credit cycle. So let's look a little bit about the futures market. It really was a strong week for some of the soft soy, coffee, cocoa rallying last week, along with the VIX, gasoline, silver, gold, and ethanol. On the other side, natural gas practically crashed down 10%, which is a small move comparatively for the energy futures contract that many call the widowmaker. Lean hogs were down 5%, cotton 4.21%, and feeder cattle 4.14%. Equity indices didn't have such a good week, with the Russell down 2.34%, 0.8%. The S&P 500 down 2.59%. The DAX 2.73%. The Nikkei 2.76%. The Euro Stoxx 50 2.84%. The NASDAQ 3.12%. The 30-year bond, though, wanted to beat them all, so it fell 3.8%. And when the long end is falling during a time of increasing geopolitical tension, that should be a warning sign for everyone that has some appetite for this sovereign duration. So let's look at the key economic events coming this week. Got a little ahead of myself there. We've got Powell's speech on Wednesday at 4:35 p.m., durable goods and GDP growth on Thursday at 8:30, and then Friday, core PCE, the Fed's favorite flavor of inflation, at 8:30 a.m. We also have some auctions coming up. We've got 2s on Tuesday and 5s on Wednesday at about $103 billion on offer. These will be really important to watch because they will help to set the tone of what the expectations of Fed policy are by the market, particularly with that 2s auction on Tuesday. And last but not least, here is a picture of the earnings this week ahead. And this chart only shows the most anticipated. It is by no means a complete measure. Something like 30% of the S&P 500's market capitalization will be reporting this week. So it will be a big week. It'll be very important, even if you're not tuned into the fundamentals, even if you don't care about earnings, to be cognizant that these are risks that could reshape the market in either direction. That's the key. Keep your mind open. The risks have grown to the downside. There's no doubt about that. But we're also entering a period where a lot of views on the market can change depending on what these companies tell us. So even though I have a pretty strong conviction about my bearish view on what's going to happen next, I'm not going to express it with a huge aggressive position because I want to navigate through earnings season and see what information we can gain from that, which may either reinforce or invalidate my view. And finally, we've got options. S&P 4200 is a key level of gamma exposure. We can see it's the largest area of net gamma exposure. It's also a huge area of gross gamma exposure. Crossing below it would unleash a lot more selling. This is an area that bulls absolutely have to defend. Even though everything looks bad, if we could get a meaningful bounce from 4200, it might at least provide a counter trend pop that could be worth selling into if one is so inclined. So I want to thank everyone for watching this presentation. I know that I covered a lot. It was about an hour long. There's a lot to dive into. I wanted to try a video format for this because I really wanted to walk everyone through my thought process, why I'm looking at things the way I am, and that warning that I'm putting out there that, you know, arguably the risks are growing to the downside. It doesn't mean it's time to take decisive action immediately, but it does mean it's time to pay much closer attention to what's happening because earnings, economic data, key technical levels, what's happening with options flows, all these things are going to matter even more for price discovery in the weeks and months ahead. And that's exactly what we'll be focusing on here in Trader Aid. So if you have any questions, let me know in the comments. Otherwise, I hope you enjoyed this presentation and I'll catch you next time.